You're about to join into the world of systematic market cycles. Learn the most dependable and consistent, yet often overlooked investment strategy. Welcome to the Technical Intrinsic Value Podcast.
Usually when we talk about a medical diagnosis, there's this expectation of, clinical precision.
Right, you feel like engineering.
Exactly. Like you break your arm, the x-ray shows that jagged white line, and the doctor just points at the film and says, there it is. That's the problem.
It's binary. It's clean. And psychologically speaking, that is deeply comforting to us. Mm-hmm. Human beings are just hardwired to want things to be visible, categorized, and, easily explained by a direct cause.
We want the why.
Yeah.
But then you step into the world of the global financial markets, and suddenly that x-ray machine is just completely broken.
Oh, completely shattered.
Yeah, we're looking at a diagnostic landscape that is honestly just murky. You have millions of highly educated people staring at the exact same ticker tapes, the exact same quarterly earnings reports, the exact same macroeconomic data, and they are all walking away with entirely different diagnoses of what is going to happen next.
Because traditional finance is fundamentally built on people peering into that murkiness and trying to construct a coherent narrative.
A story.
Exactly, a story. They desperately want to know the why. Why did the stock move? Was it the CEO's tone on the earnings call?
Right.
Or was it a supply chain rumor? They're looking for a story.
And mapping the flaw in that story-driven approach is exactly what we are doing today on the Technical Intrinsic Value Podcast. Welcome, everyone.
Glad to be here for this one. It's a massive topic.
It really is, because today we are exploring the life of a man who looked at these muddy waters, threw away the x-ray machine entirely, and realized that the narrative, that whole why we just talked about, was actually a massive psychological trap.
A mathematician who realized you don't need to understand the story to completely conquer the market.
Exactly. Now, just to give you, the listener, the proper context before we really jump in, the entire analytical framework we are using to dissect this story today is based on the proprietary Technical Intrinsic Value model, or TIV.
Right.
And this was developed by Nicolau Primavera Carvalho, and we're drawing heavily on his extensive research articles for this deep dive.
And I should definitely mention, for anyone who finds themselves fascinated by the mechanics of this systematic approach as we get into it, Nicolau's Technical Intrinsic Value book is available right now on Amazon.
It's a great read.
It really is. It basically serves as the operational manual for the philosophy we use to decode these markets.
And if you want to go beyond the book, like if you actually want to master this methodology hands-on, you can join the waiting list for the exclusive TIV program. That's at www.technicalintrinsicvalue.com.
And it's super exclusive, right?
Yeah, absolutely. Nicolau runs this live program with a strict maximum of only 5 students per cohort.
Oh, wow. Just 5.
Just 5. It's not a massive, anonymous webinar. It's an elite, deeply personalized mentorship. So again, that's the waiting list at www.technicalintrinsicvalue.com, which honestly perfectly mirrors the kind of rigorous, tight-knit academic culture we are about to talk about.
It does. It really does. Because the subject of our deep dive today is Jim Simons, a literal legend. He was a theoretical mathematician who built the greatest wealth generation machine in human history. And he did it by completely shattering every established law of Wall Street.
Let's lay out the sheer scale of what he achieved, because frankly, the human brain struggles to comprehend compounding numbers at this magnitude.
It really does.
We are talking about the Medallion Fund, which was the flagship quantitative fund he ran at his firm, Renaissance Technologies.
To really put it in perspective, we have to look at the benchmark. So between 1988 and 2018, the Medallion Fund generated an average gross annual return of 66.1%.
66.1%. Gross.
Yeah.
Every single year on average for 3 straight decades. I mean, that shouldn't even exist.
It completely defies traditional economic theory. But here is the truly staggering part. That return was 39.1% net of fees.
Right, the fees. We got to talk about the fees.
Because we aren't talking about standard Wall Street fees here. The industry standard for hedge funds has long been 2% management fee and a 20% cut of the profits.
Pretty standard.
Renaissance charged a 5% management fee and a staggering 44% performance fee.
44%.
They took nearly half of all the profits generated, and they still delivered almost 40% net annually to their investors.
Let's ground that in reality with a concrete example for you guys listening. Say it's 1988. You have $10,000 to invest. If you handed that 10 grand to Warren Buffett, who, is universally considered the greatest fundamental, narrative-driven investor of all time, compounding it roughly 20% a year.
Which is amazing.
Right. By 2018, your $10,000 would have grown to roughly $2.4 million.
Which is an absolutely phenomenal generational return.
It is. Anyone would be thrilled with that. Now, if you just put that $10,000 in a standard S&P 500 index fund over that same period, you'd be looking at roughly $100,000.
Sure.
But if you had somehow managed to invest that $10,000 in the Medallion Fund in 1988, 30 years later, net of those massive fees, your 10 grand would be worth over $200 million.
From 10,000 to over 200 million?
It's insane.
A $100 investment literally turned into over $2.1 million. Just to put the percentages on it, the benchmark index returned about 914% over that time. Medallion returned over 2.1 million percent.
Wow.
It is a mathematical anomaly that basically makes an absolute mockery of the efficient market hypothesis.
So how did he do it? I mean, to understand the machine, we really have to understand the architect. And the genesis of Jim Simons is crucial because his mind was completely untethered from the culture of traditional finance.
Right.
He didn't come from a legacy banking family or anything like that.
Not at all. Simons was born in 1938 to a Jewish family in Massachusetts.
Yeah.
And his parents, Marcy and Mattie Simons, they ran a small shoe factory.
A shoe factory.
Yeah. But from a very early age, Jim was driven by this pure, abstract mathematical inquiry.
There's this great detail from the biographical sources we were looking at. At 14 years old, he was working a menial job sweeping floors at a place called Breck's Garden Supply.
Right, the garden store.
Yeah, and he was terrible at the inventory stuff. He just couldn't keep track of it. But he was fiercely determined to pursue mathematics. He was already telling people he wanted to go to the Massachusetts Institute of Technology, and the people around him, like his boss at the garden store, were highly skeptical.
To put it mildly. But he didn't just get into MIT. He completely fast-tracked his education. He completed his Bachelor of Science in Mathematics in just 3 years, graduating in 1958.
Unbelievable.
And from there, he moved out west to the University of California, Berkeley. By the time he was 23 years old, he had earned his PhD under the supervision of Bertram Costa.
23 years old. Most people at 23 are, just trying to figure out how to write a decent resume, and he is publishing a new proof for Berger's classification of the holonomy groups of Riemannian manifolds.
Rolls right off the tongue.
Yeah, exactly. Now, I have to stop you here. For anyone listening who hasn't taken advanced graduate level topology, we cannot just throw a phrase like holonomy groups of Riemannian manifolds out there. What in the world does that actually mean?
Fair enough. Let's break it down without the dense jargon. So imagine you draw a triangle on a flat piece of paper. The angles add up to 180 degrees, right?
Right.
If you slide that triangle around the paper, it stays the exact same. That's flat space. But now, imagine you draw a triangle on the surface of a globe, say, starting from the North Pole, down to the equator, across and back up.
Okay, I'm picturing it.
Those angles add up to more than 180 degrees because the space itself is curved.
Okay, I'm with you.
So a Riemannian manifold is essentially a mathematical framework for describing spaces that curve and warp in multiple dimensions. And holonomy is the study of how an object, like a mathematical vector, rotates or changes as you move it in a loop around that curved space.
So she's not just looking at 3D objects.
No, Simons was essentially mapping the fundamental rules of how multidimensional invisible spaces twist and warp.
So he is literally building mathematical architectures for structures that the human eye cannot even perceive.
Exactly. He established himself almost immediately as a formidable geometric topologist. And this actually culminated in 1974 when he collaborated with the legendary mathematician Chien-Shiung Chern.
Right, the Chern-Simons invariant.
Yes. Together, they developed the Chern-Simons invariant.
And this wasn't just some obscure academic paper that got filed away.
No, it was profoundly fundamental. Originally, it was a purely abstract topological concept. But a decade later, theoretical physicists discovered that the Chern-Simons invariant perfectly described how quantum strings behave in multidimensional space.
Oh, wow.
Yeah, it became a cornerstone of string theory, condensed matter physics, and eventually quantum computing. He actually won the Oswald Veblen Prize in Geometry in 1976 for this exact work.
Okay, so we have a genius-level academic.
Yeah.
He is operating at the absolute frontier of theoretical math, but academia couldn't hold his attention completely, right?
Yeah, it couldn't.
And here's where the story takes a fascinating turn. Because in 1964, right in the thick of the Cold War, he's recruited by the Institute for Defense Analyses, the IDA, in Princeton, New Jersey.
The IDA was a highly classified shadow environment. Simons wasn't teaching geometry there. He was working as a military cryptanalyst for the United States government.
Oh, breaking.
Code breaking. His specific task was to develop algorithms to crack encrypted Soviet communication systems.
And he's working alongside heavyweights like Lenny Baum, right?
Yeah.
The guy who co-created the Baum-Welch algorithm.
Exactly.
But I have to ask a question here, because this seems to be the pivot point of his entire life. He wasn't looking at corporate balance sheets or PE ratios at the IDA. He was staring at intercepts that looked like total static.
Just noise.
Right, noise. How does breaking a Soviet cipher translate to breaking the stock market? I mean, is it like looking at a TV screen full of static? But if you squint hard enough and use the right math, a crystal clear image of a localized trend emerges.
That's a really good analogy. To answer that, we really have to look at how a cryptanalyst views data versus how a normal person views data.
Okay.
To the untrained eye, a heavily encrypted Soviet transmission is just a chaotic, visually jarring jumble of random letters and numbers. It looks like absolute static. There is no story. There is no narrative.
Right, it's designed specifically to look like pure randomness.
But to a cryptanalyst, total randomness generated by a human system is an illusion.
Because humans can't really make true randomness.
Exactly. Because language has rules. Every language, no matter how heavily you scramble it with a cipher, leaves a microscopic trail of its underlying structure. You might have a recurring vowel pairing that happens 0.1% more often than it should.
Oh, interesting.
Or you might have a rhythmic cadence hidden deep within the static. Simon's job wasn't to guess the underlying words. His job was to build mathematical filters that could scrub away the background noise until that hidden, highly ordered statistical rule set revealed itself.
So he is staring at the Soviet static, and at some point he looks at the stock market ticker tape, and he sees the exact same thing.
Precisely. This is the great epiphany. To Wall Street, a stock price moving up or down was a story. It was an earnings report, or a CEO resigning, or an inflation print.
The narrative.
The narrative. But to Simons, the ticker tape wasn't human opinion. It was just another noisy communication channel. It was an encrypted, chaotic stream of data wrapping around an underlying mathematical reality.
So if a military cipher can be broken by mapping statistical regularities, why couldn't the global financial markets?
That was his foundational thesis. But, he didn't get to test it immediately.
Right, things got derailed.
Yeah, in 1967, his time as a codebreaker came to an abrupt end. Simons was deeply opposed to the Vietnam War, and he actually wrote a public letter to the New York Times expressing that opposition.
And as a historical biographical fact, we are just relaying that publicly opposing the war while working for a defense contractor resulted in his immediate termination.
Right, he was fired from the IDA.
So he finds himself out of a job, and he returns to academia. He takes over as the chairman of the mathematics department at Stony Brook University. And he spends 12 years there, turning it into one of the premier geometry research institutions in the entire country.
You really built it up.
He collaborates with Nobel laureates. By all traditional metrics, he has reached the absolute pinnacle of academic success. But that puzzle of the markets, that encrypted signal, is still gnawing at him.
It was an existential itch he couldn't scratch in a university setting. So in 1978, at the age of 40, which, is quite late to start a completely new career,
Very late.
Simons walks away from his prestigious academic leadership role to launch a trading firm.
And he doesn't launch it in a glass skyscraper in Manhattan with mahogany desks. He launches a firm called Monometrics in a nondescript suburban strip mall in Long Island, right next to a woman's clothing boutique.
It is the least glamorous origin story for a financial empire imaginable.
It really is.
And the funding for it came from an incredible place, too. After he graduated from MIT in 1958, Simons went on a motorcycle trip from Boston all the way to Bogota, Colombia, with two classmates, Jimmy Mayer and Joe Rosenshine.
I love this detail.
20 years later, those old friends provided the core financial backing for his early trading structures. They funded the Medallion Fund, which was essentially the operational precursor to Medallion.
But this transition from theoretical mathematician to Wall Street titan wasn't a straight line. I think we love the myth of the genius who just walks into a new field and instantly dominates. But Simons actually had to go through a deeply painful failure to force his structural evolution.
Yeah, the early 1980s were grueling for him. And the reason he struggled was because he started out trading the exact same way everyone else on Wall Street did.
Discretionary trading.
Exactly. Using standard economic intuition, discretionary judgments, and fundamental analysis. He was reading the news, looking at macroeconomic data, and trying to predict where currencies and commodities would go based on his gut feelings.
He fell right into the trap of the narrative.
He was entirely trapped by it. And because he was trading on human intuition, he was plagued by the exact same emotional cycles that destroy retail traders every single day.
The fear and greed.
Yes, the anxiety of a mounting loss, the overwhelming urge to double down on a losing position, the desperate hope that the market will turn around and validate your thesis.
We've all been there.
The sources describe an agonizing period where an employee actually walked into Simons' office and found him lying flat on the couch, staring blankly at the ceiling, completely overwhelmed, basically confessing that he felt like he had absolutely no idea what he was doing.
That is such a humanizing image. The man who would become the greatest quantitative investor of all time, lying on a couch in a strip mall, feeling like a total failure.
It was a profound psychological crisis, but it was the necessary catalyst. While lying on that couch dealing with the pain of those losses, he had a structural epiphany.
Okay, what was it?
He realized that the primary source of his operational failure was human intervention. Human emotion is the ultimate enemy of compounding capital.
Let's dig into that for a second. Because financial news networks constantly glorify market intuition or a veteran trader's gut feeling, we hear it all the time. Why did Simons decide that traditional fundamental investing, this whole idea of understanding a company's products, its management, its cash flow, was actually a toxic approach for his goals?
Because fundamental investing requires you to ask why a stock moves. You are analyzing narratives. You are reading earnings reports, looking at supply chain disruptions, evaluating the macro environment. You are trying to find causation.
Right.
But Simons realized two massive flaws in that approach. First, human narratives are inherently biased by our emotions, fear, and greed. Second, and more importantly, fundamental analysis is almost always backward-looking.
Oh, that's a great point.
By the time you, as a human analyst, understand why something happened, the market has already priced it in.
You're basically trying to predict the future by reading yesterday's newspaper.
Yeah. Exactly. Systematic quantitative trading, on the other hand, asks a completely different question. It doesn't ask why. It asks what.
What is the pattern?
What is the mathematical pattern? It completely decouples from the narrative. Simons realized you don't need to understand the meaning of the encrypted message to exploit its structure. You just need to prove, with ironclad statistical certainty, that a specific, tiny anomaly repeats under specific conditions.
You don't need to know why the anomaly exists.
No, you just need to mathematically prove that it does.
So he realizes the market isn't a casino driven by human fear and greed. Well, I mean, it is. But underneath it all, it's an intricate, nonlinear system waiting to be deciphered.
Right.
But to build a machine capable of deciphering it, he knew he couldn't use the people who were currently running Wall Street.
No, he viewed entrenched Wall Street culture as an intellectual virus.
So he completely bans the experts. In 1982, he rebrands the firm to Renaissance Technologies and institutes a strict, unyielding hiring policy. No finance degrees, no MBAs. If you spent 5 years on a trading desk at Goldman Sachs, learning how to read moving averages or analyze corporate debt, your resume went straight into the shredder.
Because traditional finance professionals come preconditioned with those exact narrative biases we just talked about. They are trained to look for a story. Simons wanted blank slates. He wanted minds completely unpolluted by Wall Street orthodoxy. He needed people who fundamentally understood the scientific method.
So who does he hire? He hires astrophysicists who spent decades tracking the microscopic trajectories of distant stars. He hires string theorists. He hires computer scientists and fellow cryptanalysts.
His logic was simple, really. It was far easier to teach a brilliant physicist the mechanics of market data than it was to teach a Wall Street trader how to be scientifically rigorous.
That makes total sense.
Yeah.
One of the most fascinating recruitment grabs he made was in 1993. He brings in Peter Brown and Robert Mercer. And these guys weren't finance guys, and they weren't even studying physics. They were computational linguists from IBM's speech recognition team.
This is where the Renaissance model achieves its true breakthrough. At IBM Research, Brown and Mercer had spent years applying statistical approaches to machine translation. They treated language translation as a noisy channel problem.
Okay, let's break that down for everyone listening. What exactly is a noisy channel approach?
So prior to their work, early computer translation tried to rely on handcrafted grammatical rules. A programmer would try to teach the computer the structural rules of French and the structural rules of English, and then try to map them together.
Sounds incredibly tedious.
It was clunky, and it constantly failed because language is just too dynamic. Brown and Mercer threw out the grammar rules completely. They decided to decode an output language from an input language purely by using statistical probability distributions.
They didn't care about the grammar. They cared about the math of the words. I love that anecdote from the sources where they were secretly building this statistical model on the side while their boss at IBM, Fred Jelinek, was away. And when he came back, they just presented the results like, oh, yeah, everything's right on schedule, Fred.
Yeah. They were absolute mavericks. And when Simons brought them to Renaissance, they brought this exact linguistic framework to financial prices. Because what is the stock market if not a highly complex, incredibly noisy communication channel?
So instead of trying to understand the economic meaning of an asset, like, is this company fundamentally sound, they constructed mathematical models to analyze the raw sequences of market data just like they analyze sequences of human speech.
Exactly. And this leads us to the core mathematical concepts they utilize to build the machine, the most prominent being hidden Markov models.
Right. Now, I want to make sure we don't lose anyone here, especially students or beginner investors tuning in. Explain how a hidden Markov model actually works, but let's keep it grounded.
Okay, think about it like this. Imagine you are locked in a windowless room. You are trying to figure out what the weather is like outside, but you can't see the sky at all. The only information you have is watching a single person walk into the building every day, and you observe what they're carrying. You can't see the hidden state, the actual weather. You can only see the observable symbols. So an umbrella, sunglasses, or a heavy winter coat.
Okay, so I'm logging those objects day after day.
Right. A hidden Markov model calculates the statistical probability of transitioning from one hidden state, say, sunny to rainy, based purely on the sequence of those observable symbols over time.
I see.
If you see sunglasses on Monday, sunglasses on Tuesday, and an umbrella on Wednesday, the model calculates the exact mathematical probability of what the weather is doing and what tomorrow will bring, without ever actually seeing the sky.
And when we map that to the stock market, the true structural driver of a price, the institutional buying, the algorithmic flows, that's the hidden weather.
Exactly. And the minute-by-minute price ticks are the umbrellas and sunglasses. Brown and Mercer treated price changes as mathematical symbols, hiding a broader structure. They built algorithms to calculate the probabilities of transitioning from one market state to another, decoding short-term market inefficiencies without ever needing to know the fundamental economic driver.
That is brilliant. But they didn't just stop at sequence modeling. They also utilized something called high-dimensional kernel regression. Now, earlier you mentioned that standard finance looks for straight lines, but I want to understand how kernel regression is different. What are these dimensions they're looking at?
Well, traditional finance loves a straight line. It's called linear regression. You draw a line of best fit through a scatter plot on a 2D chart, price on one axis, time on the other. But chaotic systems like the global markets are fiercely nonlinear. High-dimensional kernel regression allows the computer to map incredibly complex boundaries across multiple variables all at once.
So what are those variables?
In a traditional 2D chart, you just have price and time. But Renaissance might build a 15-dimensional mathematical space.
15 dimensions?
Yeah. The axes aren't just price and time. You have an axis for trading volume, an axis for price momentum, an axis for interest rate spreads, an axis for currency fluctuations, an axis for the speed of the tape.
It's math.
Kernel regression finds the curved or warped boundary in that massive 15-dimensional space where an asset reliably misprices itself. It finds patterns that a human brain, which is visually locked into 3 dimensions, could never possibly comprehend.
And to find those microscopic patterns, they couldn't just look at daily closing prices, right? They had to zoom way, way in. This was driven by the mathematician Henry Laufer, correct?
Yes. Laufer was instrumental. He pushed the research team to analyze progressively finer intervals of time. While macro investors on Wall Street were looking at weekly or monthly trends, Renaissance started looking at 5-minute bars.
Oh.
They were hunting for fleeting micro anomalies, a slight, statistically significant tendency for cocoa futures to behave a certain way on a Friday morning leading into a long weekend. or a milliseconds-long price dislocation between a tech stock in New York and a related futures contract in Chicago.
It's like if the traditional Wall Street approach is a movie critic writing a review of a film's plot, analyzing the characters and the narrative arc, Simon's team were like sound engineers who didn't even care what the movie was about.
Right.
They were just sitting in a dark room, analyzing the raw audio frequencies, looking for a specific predictable spike in the decibel levels that they could trade on.
That is exactly what they were doing. But here is the challenge. How do you manage a group of people doing this? To make this bizarre collection of movie-ignoring sound engineers, these eccentric string theorists and cryptanalysts work together, Simons had to build an environment that completely defied traditional corporate Wall Street culture.
Right, because you can't just throw a bunch of theoretical physicists into a bullpen and expect them to thrive in a cutthroat alpha male banking culture.
In traditional hedge funds, secrecy is the ultimate weapon. Star traders operate in heavily guarded silos. They hide their proprietary strategies from the desk sitting right next to them because their year-end bonus depends on them individually outperforming their own colleagues.
Wow, so it's a culture of internal warfare.
Exactly.
Which, if you think about it, severely limits the processing power of the firm as a whole. You have all these smart people working against each other.
Simons realized that was wildly inefficient. So at their campus in East Sedacat, he instituted a concept of absolute internal transparency. Inside Renaissance, there were no separate trading desks. There was no European equities desk competing against the commodities desk. There was only one single unified mathematical model.
The machine.
The machine. Every scientist, whether they were an astronomer looking at data or a linguist coding algorithms, had full access to the entire source code of the fund.
So if a researcher found a tiny structural anomaly in European currency spreads, they didn't hide it in their personal portfolio to protect their bonus.
No, they coded it directly into the central system, which immediately improved the predictive power of the entire model.
And how did he enforce that? Because human nature usually defaults to greed.
He enforced it by changing the compensation structure. Bonuses weren't based on individual portfolio performance. They were based on a shared pool tied to the net profits of the entire Medallion Fund. It completely eliminated internal rivalry. If the machine won, everyone won. He managed them like a university dean running a collaborative physics department rather than a CEO running a bank.
And this flat culture, this open data sharing, is what enabled them to combine their insights to define their mathematical edge. Now, I want to talk about this edge because I think a lot of people hear 66% annual returns, and they assume the Medallion Fund must have built a crystal ball. They assume Renaissance must be predicting the market correctly 80% or 90% of the time, but that isn't true at all, is it?
Not even close. Simons famously noted that their predictive models were right roughly 51% of the time. They were barely better than a coin flip.
Okay, I have to push back here. Because mathematically, that sounds absurd to a layperson. If they're only right 51% of the time, how does that create a $200 million return on 10 grand? How does a 1% advantage equal absolute dominance?
It all comes down to volume, execution, and the laws of large numbers. Think of it this way. If you have a rigged coin that lands on heads 51% of the time, and you flip it 10 times, you might easily get 6 tails and lose money. The sample size is too small. Variance can crush you.
Right.
But if you flip that exact same coin millions of times, variance flattens out and the laws of probability take over.
It's the casino model.
Exactly. Look at a European roulette wheel. It has 37 slots, and only one is the green zero. The house edge is tiny, around 2.7%. The casino doesn't win every spin. They lose constantly. People walk out with massive payouts every night.
Yeah, you hear those stories all the time.
But the casino doesn't care who is betting, or why they are betting, or what their lucky number is. They just know that over millions of spins across thousands of tables, that tiny 2.7% edge becomes an absolute, unshakable statistical certainty of immense wealth.
And Renaissance was placing millions of bets a day across every liquid asset class on Earth. They were the house. They just needed to keep the wheel spinning. But this brings up a huge operational risk, because if you bet your entire bankroll on one spin, even with a 51% edge, you will eventually hit a losing streak and go bankrupt.
Precisely. And this is where another core mathematical concept comes in. The Kelly criterion.
Explain the Kelly criterion. I know it's crucial here.
The Kelly criterion is an information theoretic formula developed by a researcher named John Kelly at Bell Labs. It calculates the mathematically optimal fraction of your capital to allocate to a given trade based on your exact probability of winning and the payoff odds. It is the pure science of proportional betting.
So it tells the algorithm exactly how much money to wager to grow the fund as fast as possible without blowing up the account during an inevitable streak of bad trades.
Yes. It maximizes geometric growth while mathematically insulating the portfolio from catastrophic ruin. It perfectly balances aggression and survival. But even with perfect Kelly sizing, there is a physical limit to this strategy in the real world. And this is why Simons rigidly capped the Medallion Fund at roughly $10 to $15 billion and actually kicked out all outside investors in 1993.
Let me challenge that. Because if the math is so perfect and the edge is a statistical guarantee over large numbers, why cap it? Why not lever up to $1 trillion, unleash it on the markets, and basically buy the entire global economy?
Because of a concept called slippage. The financial markets are not infinitely deep. A quantitative strategy degrades as the capital behind it expands. Imagine you were trying to turn a massive battleship in a small bathtub.
Okay.
If the Renaissance model finds a tiny fleeting mispricing in a soybean futures contract and it tries to exploit it with $100 billion, the sheer size of Medallion's buy order will instantly move the price of soybeans before the trade even finishes executing.
Their own money moves the market against them.
Exactly. The sheer mass of their capital would destroy the very anomaly they were trying to exploit. You crush your own edge. So Simons realized that the Medallion Fund had an optimal thermodynamic size. He capped the size, and every single year they distributed the massive profits out to the employees to shrink the fund back down to its mathematically optimized scale.
It is brilliant structural engineering, but having a brilliant mathematical model and perfectly sized bets is utterly useless if the human beings running the servers panic and pull the plug when things get terrifying.
And this brings us to the ultimate test of the Renaissance system. We call it the emotional firewall.
Because Simons learned from his days lying on the couch in the strip mall that human emotion is the enemy. He mandated that the trading system be entirely automated, no human intervention. The machine executes, period. But that absolute rule was severely tested in August 2007, the quant crisis.
This is a crucial moment because it perfectly illustrates how quantitative models handle market panics versus human intuition. In August 2007, the subprime mortgage crisis was just beginning to ripple through the financial system. Suddenly, several massive, highly leveraged quantitative hedge funds ran into severe liquidity trouble. They were facing margin calls and were forced to rapidly liquidate billions of dollars in positions just to survive.
And because these competing quant funds held a lot of the same mathematically correlated assets that Renaissance held, this massive forced selling caused the Medallion Fund's models to suffer horrific collateral damage. The models lost roughly $1 billion, which was about 20% of the fund's total value at the time, in just 3 days.
The tension inside the ECEDOC at headquarters was suffocating. The computer screens were flashing deep red. And remember, these are brilliant, rational academics who pride themselves on cool, detached analysis. But they're still human.
Right.
The primal fear kicked in. They started to panic.
The sources detail how they actually crowded into Simon's office. These guys who built the machine were demanding that he manually override it. They wanted to cut their leverage, sell the bleeding positions, and sit in cash until the storm passed. Every human instinct screamed to hit the panic button.
But Simons refused.
He just looked at them and said no.
He understood the mathematical reality of a true cycle. The Medallion model wasn't built on gut feelings. It was built on long-term statistical probabilities derived from centuries of historical data. That data included periods of extreme market distress, wars, famines, and panics. If they turned the machine off in the middle of a liquidity panic, they would forcefully lock in massive artificial losses.
And more importantly, if you were sitting in cash, you completely miss the exact moment the market corrects itself.
Exactly. They would be letting a few days of localized human fear overwrite decades of mathematical certainty. So Simons looked at his panicked team of geniuses, and he chose to trust the math. He ordered them to leave the system alone. The machine kept running. It completely ignored the human drama happening in the office. And because the algorithm stayed disciplined, it kept buying the deeply undervalued assets that everyone else on Wall Street was frantically dumping.
It was systematically catching the falling knives because the math calculated that they were statistically too cheap.
And within days, the forced liquidations from the rival funds ended, the selling pressure evaporated, and the market violently snapped back to its historical mean. The Medallion Fund caught the entire upside of that massive reversion. They didn't just recover the $1 billion. They finished the month of August up significantly, and they closed the year 2007 up 73.42% net of fees.
Wow.
Meanwhile, rival funds that gave into the panic went completely bankrupt.
That is just staggering. It proves that the ultimate job of the systematic investor isn't actually to predict the market. The algorithm does that. The human's job is to defend the integrity of the model against their own ego and fear.
That is the defining operational lesson of Jim Simons' career.
But this raises a huge problem for the average investor listening today. Because you might be thinking, okay, this is an incredible historical story. Jim Simons was a genius. But I don't have a petabyte-scale supercomputer in my basement. I don't have a team of computational linguists mapping 15-dimensional kernel regressions. So is this entire philosophy useless for anyone outside a multi-billion-dollar hedge fund?
It's a valid question. And the answer lies in how we value data in modern markets. Let's draw a connection from what Simons did historically to how we can apply systematic thinking today. Back in the late 70s and 80s, Simons realized that traditional investing lacked historical context. So he sent researchers to university basements to buy old magnetic reel-to-reel tapes from the World Bank. He gathered tick-by-tick records of commodity fluctuations dating all the way back to the 1800s.
That's dedication.
His unique, proprietary access to historical data was his moat. That's what trained his algorithms.
And this ties directly into the technical intrinsic value view on current market fears. Right now, there is this massive narrative sweeping across Wall Street called the Syspocalypse.
Yes, the pervasive assumption that artificial intelligence is going to wipe out the entire software as a service sector.
Right. It's a classic fear-based narrative. The story goes, AI can write code now, therefore software companies are dead, sell everything. But if we apply a systematic, data-driven view, stripping away the emotional narrative like Simons did, the math tells a completely different story.
The TIV model points out that for established software leaders who possess proprietary data moats, and we are specifically looking at companies like Salesforce, Ticker CRM, Qualys, QLYS, FactSet, FDS, and Morningstar, AWR on AI is not an extinction event at all. It is a massive margin expansion tool.
Break that down. Why do proprietary data moats act as the ultimate defensive assets in volatile markets? Why doesn't an AI startup just crush FactSet?
Because AI models, no matter how advanced the neural network is, are entirely dependent on the data they are trained on. And AI is essentially an engine. Data is the fuel. If a brilliant startup builds an open source AI, but it only has access to public internet data, it has absolutely no competitive advantage. It's just scraping what everyone else can scrape.
Right.
But companies like FactSet or Morningstar have spent decades accumulating vast, exclusive, proprietary financial data sets.
Just like Simons hoarding those historical World Bank tapes.
Exactly. Their historical data advantage makes them insurmountable. When Salesforce applies AI to its closed-loop proprietary customer data, they create highly specific insights that no startup can replicate because the startup doesn't have the 20 years of enterprise history. The loud Wall Street narrative says these companies are doomed, but the systematic underlying reality says their moats just got infinitely deeper.
It is the exact same philosophy. Decouple from the noisy narrative of the Syspocalypse, look at the underlying structural advantage, which is the proprietary data, and trust the cycle.
And this transition into the wider world of science and data brings us to the final chapter of Simons' life. Because he proved his point on Wall Street. He built the ultimate wealth machine. But his goal was never just to hoard capital. He wanted to return to his roots in pure, unadulterated science.
In 2010, at the age of 72, he officially steps down from day-to-day operations at Renaissance, and he pivots his immense focus entirely to philanthropy. He and his wife, Marilyn, established the Simons Foundation. And we aren't talking about small charitable donations here. This foundation grew to hold over $5 billion in assets.
What's fascinating here is how he deployed that capital. He didn't fund high-profile political campaigns or slap his name on corporate stadiums. He directed his immense wealth toward basic frontier science projects that are often ignored by market-driven corporate funding because they don't offer any immediate commercial returns.
He funded the construction of massive astronomical observatories in the Chilean Andes to map the cosmic microwave background. He established the Flatiron Institute in 2016.
And the Flatiron Institute is essentially a mirror of Renaissance technologies, but dedicated entirely to natural science. It hosts dedicated computational centers using massive supercomputers to study astrophysics, quantum physics, cellular biology, and the origins of the universe. The exact same computational philosophy that was once used to ruthlessly extract alpha from financial markets is now deployed to understand the fundamental architecture of reality.
He also poured massive resources into education. He created Math for America, which currently supports over 1,000 elite STEM teachers in New York City public schools with professional development and direct salary supplements. He fundamentally believed that teaching math should be a respected, highly viable career for gifted minds. And in 2023, he gave an unrestricted $500 million endowment to Stony Brook University, one of the largest in U.S. public higher education history.
But we also have to acknowledge that his philanthropy was deeply driven by profound personal tragedy. Simons endured unimaginable heartbreak in his personal life. 2 of his 5 children died as young adults. His 34-year-old son, Paul, was tragically killed by a car while riding his bicycle in 1996, and his 23-year-old son, Nicholas, drowned while freediving in Indonesia in 2003.
It is devastating. You have the man who mathematically solved the market, who built algorithms that can predict the movements of global capital with surgical precision, but who is entirely powerless against the chaotic, random tragedy of human life.
And he responded to these devastating losses with intense empathy. He used his scientific resources to fund deep medical research, becoming one of the largest private funders dedicated to understanding the genetic architecture of autism, for example. He was always looking for ways to bring order, understanding, and relief to complex human conditions.
Jim Simons passed away peacefully in New York City on May 10, 2024, at the age of 86. And as we look at the totality of his life, from the shoe factory to the Cold War to Wall Street to the Flatiron Institute, what are the ultimate lessons here, especially for students pursuing STEM and finance today?
Simons proved that a STEM background can completely transform a financial career path. You don't need to conform to traditional economic theories or get an MBA. By replacing narrative bias with the rigorous scientific method, you can uncover structural truths that the rest of the crowd is entirely blind to. He showed that mathematical elegance and strict statistical discipline are vastly superior to human intuition when dealing with complex, chaotic systems.
And he proved that human emotion is the primary enemy of compounding capital. You have to decouple from the why, stop looking for a story, and build your own emotional firewall. Okay, let's recap this incredible journey. We started with a young math prodigy sweeping floors at a garden supply store. He becomes a Cold War cryptanalyst, cracking Soviet ciphers, loses his job for standing by his principles, revolutionizes modern geometry with the Chern-Simons invariant, and then walks away from the peak of academia to start a hedge fund in a suburban strip mall. He bans the Wall Street experts, hires linguists and astrophysicists, builds an emotionless machine that generates 66% annual returns for 30 years, and then gives his billions away to study the stars and human genetics.
It is a life that almost defies fiction.
It really does. And I want to remind you listening, if this systematic, data-driven philosophy resonates with you and you want to stop gambling on Wall Street narratives and start engineering your own analytical certainty, you absolutely need to check out the Technical Intrinsic Value book on Amazon.
Definitely read it.
And do not forget to join the waiting list for the exclusive 5-student TIV program at www.technicalintrinsicvalue.com. Nicolau Primavera Carvalho is teaching this methodology directly, and space is incredibly limited.
As we wrap up, there's a fascinating paradox in Simons' life that I think is worth mulling over. By building machines that completely removed human emotion, human intuition, and human narrative from the equation, by being utterly cold, systematic, and mathematical, he ended up generating the vast, unprecedented resources needed to fund the most fundamentally human endeavors we have. Understanding our genetics, exploring the cosmos, and seeking the origins of life itself.
Wow.
Perhaps the ultimate lesson isn't about teaching machines to think like humans. It's about recognizing exactly where humans should step back, strip away their ego, and let the math speak for itself.
So the next time you look at the markets and all you see are those diagnostic muddy waters, remember Jim Simons. Stop looking for the jagged white line on the broken X-ray machine. Listen to the static, find the signal, and trust the math.
Until next time.
That's it for today. I'll see you in the next episode. The Technical Intrinsic Value Podcast is a systematic explanatory to enhance data analysis and delivery. All content logics provided herein are a direct reflection of the opinions value modeled Nicolau Primavera Carvalho. The information provided is for educational and informational purpose only and does not constitute financial, investment, or legal advice. The TIV model is a framework designed to identify patterns based on 15 years of future results. All investments involve risk. By continuing, you acknowledge you are a self-reliant investor responsible for your own execution.